Shockwaves rock Wall Street as tariff threats from D.C. rain down on supply chains. Will market complacency disappear when trade war risks clash with AI-fueled optimism, or will policy drama, earnings season, and economic splits keep traders searching for the next reset?
Chinese against U.S. technology supply chains. Here's what the president posted just a short time ago. He said, "I was to meet President Xi in 2 weeks at APEC in South Korea, but now there seems to be no reason to do so." He also writes, "Dependent on what China says about the hostile order that they have just put out, I will be forced, as the President of the United States of America, to financially counter their move. For every element that they have been able to monopolize, we have too." He goes on to threaten massive increases in tariffs here and says that the U.S. administration is considering what its moves might be. So no specific retaliation here yet, Scott. What we've got is a rhetorical firing up of the response from the president, threatening a number of actions, including canceling that summit between Trump and Xi Jinping that was expected to happen in South Korea. We don't know if that summit is now canceled or not canceled, or what its status might be. We're trying to get that information from the White House right now. But clearly, tensions are much higher today than they were yesterday between the United States and China on the trade front. We'll see what specific moves come from this administration today, if they come at all today. Scott, back to you.
Eamon, thank you very much. You keep us up to date. Eamon Javers at the Bureau in Washington for us. Certainly enough to make the market a little uneasy. And Rob, stand up and take notice. It's worth noting as well that prior to today, the S&P had gone 33 sessions without a 1% move. We obviously, for the moment, have that down 1.5%. And it's largely where you would probably expect to see the weakness within chips, NVIDIA, Broadcom, Micron, AMD, et cetera, and some other names that have what you would consider to be exposure to China. What do you think?
I think the sharp reaction to this news shows how price for perfection markets have become and how subject to a little bad news they could be. Markets were at 22.9 times as of yesterday. You've seen surging optimism looking at the AAII surveys, and the markets could potentially move in any risk from tariffs. Let's remember that China tariffs were already at 30%. And, you know, a massive increase would bring rates back up to levels that could be incredibly disruptive. The market is, high beta is underperforming today. It's down by 3.7%, where defensives are outperforming. You're seeing credit underperform. The reality is markets have become solely focused on the good news around AI, and they're ignoring any potential risks from the shutdown, incremental weakening in the labor market, and so you get a little piece of news that's unsettling, and you can see a shock like that.
There's definitely, Steph, I think to Rob's point, been a fair amount of complacency, certainly around the issue of trade and tariffs. Sure. Mm-hmm. We haven't mentioned those two T words in a long time because, as Rob said, we've been fixated on AI. We've been thinking about earnings and how good they're going to be and the fact that the Fed's cutting interest rates. But we're, certainly reminded right in our faces today that these issues still exist. An issue with the most, fierce competitor that we have, I think, globally on trade.
So we're only down 1.3% on this news. That, I think, is encouraging. And I think that is because if you step back, first and foremost, you have to assume that cooler heads will prevail. We have a little bit of time between now and when maybe Xi and Trump will meet. So we've got probably 2 weeks of noise. That's okay. We're looking for opportunities to be buying the noise because of all the things you just said. Better economic growth, decent consumer, AI renaissance, good earnings. Earnings are going to be very good. And the good news is on Tuesday, we start to get earnings. And which I think the banks are going to be very strong. And you're looking for opportunities, though. So to only be down 1.3% in the face of all of this, I think that's actually encouraging, and it speaks to people wanting to buy the dip. And I think that they will, and I think they should.
Well, I mean, it's been a pretty quick reversal as you're looking on the screen. Right now, it's 1.5%. I mean, there are significant questions, Jay, about kind of where we are. Not even outside of AI and the bubble question, which is being asked, every 5 minutes. Right. Obviously, where's the economy going? Bank of America data today shows what really looks to be two economies. To be quite honest, their data shows lower income consumer spending is growing at 0.6%. higher income growing at 4 times that. So that's
Absolutely.
where the economy is being carried by the high-end consumer,
Yep.
and it's being carried by AI.
No doubt about it. I mean, it's definitely two tapes. It's fully bifurcated in terms of the high-end consumer versus the lower-end consumer. Top 10% represent 50% of spend. There's no doubt about that. And I think, as it relates to what's going on today, this is an absolute buying opportunity from our vantage point. Why? Because GDP is at 3.8%. Yes, we are underway a cutting cycle. We'll see. Kind of, we've heard from Hawker today and some Fed speak this week. I think that will be stimulative to the economy. The big beautiful bill will start to run into play through the end of this year into next year, which I think will also be stimulative to the economy in the short run. And earnings, to Steph's point, we will start in earnest next week on Tuesday with financials, which we expect 12% earnings growth. So I like a lot of what's going on right now for the market. This is an opportunity for me.
Market was primed anyway for some level of pullback. Whether this is the beginning of anything, who knows? We'll watch. Dow's down almost 600 points. I do think it speaks pretty loudly to the complacency that's been in the marketplace about almost anything outside of the positives to AI, rate cuts, the economy, and whatever else you want to throw into that basket.
During the entire opening of the show, you're the first person to mention rate cuts. And I feel like that's the thing that's in tandem with the AI enthusiasm is when you've got a rate cutting cycle, it's like, what else could the stock market wish for? So to Stephanie and Jason's point, if there's a pullback today, I think there's opportunity there. Kind of pivoting to what you say, Rob, if you look at 22 plus forward earnings, which for old people like us, like that's pretty out of control, but it's a handful of names that are buoying the entire markets. So if you lose the AI enthusiasm, Scott, or if the Fed backs off of the rate cuts, even more so than tariff talk, that could be the reset that I would be a little bit nervous about, where maybe instead of 22, you go down to 20, and now you're 600-700 points off the S&P.
Well, I mean, now you're talking about a game changer scenario for the markets. Those are sort of dramatic risks that would be out there and that would have to roll for the market to have a significant problem. I mean, even with the pullback, we can look at NVIDIA. We're not that far away for $5 trillion in market cap. Now, this bit of upset is obviously front and center for us as we come on the air for you. So we're at 189. We need 205. So, maybe we get that in earnings. Maybe we don't. But that's been one of the stories there. There's Morgan Stanley positive on that name. AMD's best week since 2016. You've got the Qualcomm news that Mackenzie Sagalos was talking about earlier, where China opening this antitrust probe there. So there's just a lot of tension bubbling back over the surface as we see today. Rob, you have Qualcomm. Jason does too. Mm-hmm. I'm just curious, as you think about all this playing out, if the meeting between the president and President Xi wasn't supposed to be for a couple weeks. Mm-hmm. So if you get, more rhetoric between the two sides, or at least from this end, what that might mean for the market as it looks ahead to a potential meeting between the two.
You make an important point. What is the breaking of the linkage that we've seen? The linkage between AI CapEx, equity markets, the U.S. consumer, and the U.S. economy. There's a positive and virtuous feedback loop going on. AI capital spend fuels earnings. Earnings fuel positive stock performance. Positive stock performance fuels the the wealthiest U.S. consumers that are exposed to the market, and that fuels the economy. So anytime you're going to see something that challenges the break in that link, it specifically challenges it in the areas that have done really well, although Qualcomm has lagged quite a bit because of its exposure to China. You're going to have a situation where you get a dramatic pullback, especially in the names that have participated quite a bit. So I don't think this is broken, but these links will become challenged from time to time. And as long as you think this is still in play, and we certainly do through year end, these pullbacks provide opportunities for investors that want to stay long to get in.